That's enough about equities. Let's talk about commodities. Manisha, what are you tracking today?
Well, I'm looking at the crude oil prices, and joining me is a very special guest. We have Sushant Gupta, director at Mackenzie, now joining us live. Sushant, hi, good to have you. First question clearly is about OPEC and allies, because that is where we started this week with a lot of surprise really and a knee-jerk reaction. And much of those gains is what the crude prices seem to be holding on even now.
Yeah, thank you, Manisha. I think OPEC's decision to cut about 1.6 million barrels per day, from May until end of 2023. Was a surprise. We believe it will provide a support to an already tightening market, which we expect in the second half of 2023. But I think, the market should realize a few things, which are behind the OPEC cuts, right? First of all, although the cuts, took market by surprise, the OPEC plus production was already running below their target. Right, so the overall cuts which the market will see, won't be the full 1.6 million barrels per day. Right. The second thing is, the reason for the cuts, right? I mean, obviously, one view is to support the prices, which went down in the last few weeks, because of the fear and the risk driven by the banking crisis. Right, and plus we do have seen some weakness in Q1 demand numbers. Which may have driven, the rationale behind these cuts, right? But I think let's not forget the current prices where we are today. They are, back to where we were, a pre-banking crisis, at around $85 per barrel. So in effect, right, we're back to, a few weeks back when the prices were around the same level. So, the impact is not as dramatic as the market may, make it look like.
Sushant, when you speak about the first quarter demand, and as you mentioned, the demand growth wasn't as strong. I mean, do you have any numbers at hand on what the global demand was in the first quarter, or even Asia for that matter?
Yeah, I think for a global level, our current estimated the oil demand grew by around 1.1 million barrels per day. There was some weakness coming in from the US and also, weakness coming from China, as we've seen some of the petrochemical projects were delayed in China towards the second half or next year.
And what are your estimates for the demand growth for this quarter?
Right. So for Q2, as we estimate that the Q2 would be a much more stronger demand growth. So our current estimate stands around 2.8 million barrels per day of demand growth for Q2. And that's why we were always saying that, Q1 in terms of prices, would be the weakest. As we head towards Q2, the demand growth will be much stronger, partly driven by China. And that will support the overall prices. So around 2.8 million barrels per day of demand growth at a global level for Q2 this year.
Fair point that. The other thing that is supporting the commodities, especially gold and silver and also crude to some sense, is that much of the trade now is shifting out of dollar to the regional currencies. We've seen that happen with China, with Saudi Arabia. Russia also has been pushing for it. Is that in any sense changing on how the global crude trade will happen from here on?
Well, I believe, I think the overall, shift towards the other local currencies or trade in the local currency, I think it's a very small fraction of the overall, US dollar trade, right, for the crude oil, right? So we don't think, the weakness in the dollar, or for that matter, the shift towards local currencies trade will have a significant impact on the crude trade. The crude trade will be driven by, a much larger factors. One, the fundamental one is the oil demand growth, right? If India needs X KBD of oil to be imported, it has to import it, that crude oil. A large part is still driven by the US dollar trade, right? So, and the second part will be, the reshuffling in the trade we are seeing because of the Russian sanctions. Right, so we're seeing India buying more and more, Russian crude. We have seen, the highs of, India buying close to 1.3 million barrels per day of crude oil from Russia, which, from nothing, in 2021. Right, so so that will start to reshuffle the crude trade rather than the shift in the local currencies buying, which is still a very small portion of the overall US trade.
What is your sense on the crude prices going forward from here? I mean, as you said, the first quarter demand was weaker. So were the prices really? How are you looking at this quarter and the next?
So, just to put things into perspective, right? Q1 Brent average was roughly around $81 per barrel, right? Now, I think as we move towards Q2 of this year, we do expect a meaningful appreciation in the prices, driven now, by the first factor which I mentioned before was the stronger demand growth at a global level, driven by China particularly. And now with the OPEC plus production cuts, which will have some support to the prices. So overall for Q2, we are forecasting the prices could appreciate towards $88 per barrel average for Q2. But as we head towards the Q3 and Q4, which is where we see the market getting more tighter, where we see prices could average roughly around $94 per barrel for Brent.
And how are you looking at the Indian demand growth going forward? I mean, we are importing cheap from Russia, and that is expected to continue for the rest of this year and perhaps longer. But what is your sense on demand here? And also, are you looking at Russian Urals as pricing policy?
Yeah, so India's GDP grows by around 6.5% this year, right? It definitely is expected to be a bright spot in the global demand growth, right? So India accounts for about 200,000 barrels per day of demand growth this year. And India's overall demand reaches around 5.4 million barrels per day. Now, in terms of where this crude will come in, right? I mean, so obviously, as I was saying, Russia is a major part of India's crude imports. We have seen India importing roughly around 1.3 million barrels per day at max in the last few months. And we expect that to continue, one, because the Urals discount are running at $40 below Brent. And that actually facilitates a lot of the shift of this trade towards India and, for that matter, China. India would still need to keep on buying crude from the Middle East because overall India's import dependency is still close to around 88%, right? So it doesn't. Russia's imports do not fully meet India's, crude import needs, right? It need to import crude from Africa, from Middle East, and also from the US. But it just India, it just gives more diversification to India's crude import sources going forward.
Fair point.
Okay, all right, Manisha. Thanks very much for that. So that's on Brent crude, $85 per barrel currently.